The Vanguard index funds are the gold standard in terms of investment options out there. But out of all of the funds that are available to us, there are two main funds that stand out the most to investors. The Vanguard VUSA S&P500 ETF is up there with one of the best investments you can make, and is one that I personally hold within my investment portfolio. But a fund that's less spoken about but equally has its merits is the Vanguard VUAG S&P500 ETF. Two funds that pretty much sound identical, but with differing ticker symbols. The funds are actually slightly different. So the question of today's video is, what are the similarities and what are the differences between both of these funds? Which one performs better? Which one should you potentially think about investing in order to align the best to your own personal investment objectives? And which one you should fundamentally hold within your stocks and shares ISA account? Well, let's find out.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund.
So don't take it from me, take it from the wise words of Warren Buffett. The S&P 500 has been a very sound investment in the past and will likely be a sound investment in the future too. Holding it through thick and thin and simply not deviating from your overall investment strategy. Simply put, if you believe in the continued growth of the American economy, the American stock market, and big tech, which is one of the predominant drivers of growth in the US stock market, then investing into a stock market index tracker which tracks the performance of some of the best companies over in the States is probably quite a wise investment to make. But which stock market tracker do you choose? Between the VUSA or the VUAG? Both track the same index, but both fundamentally do different jobs. So let's take a look at the detail. So first up, let's talk about the similarities of the fund to begin with, starting off with the fund holdings. Now, as you guys can probably imagine, because they both are S&P 500 trackers, well, they have exactly the same holdings within them. It's got all of the familiar names which you'd probably expect, which include all of the big boys like Apple, Microsoft, Amazon, Tesla, and Alphabet. And with these ETFs being weighted, the biggest stocks by market capitalization actually have the largest holding within the index. And when we talk about market capitalization, it's simply the number of shares in circulation multiplied by the stock's current share price. So in a hypothetical world, let's say we had Seb's Sandwich Shop, which was a publicly traded company and had 1,000 shares in circulation. And that company traded at $5 per share. When we multiply the 1,000 shares by the $5 per share which it trades at, then you have a market capitalization of $5,000. It really is as simple as that. Now, while Seb's Sandwich Shop certainly won't be included within the listings in the S&P 500 ETF, within the big companies that are within this ETF, there are some kind of small minor differences between the VUSA and the VUAG fund. We are only talking a small fraction of a percentage point between some of the holdings, but nonetheless some minor differences within there. Then we have another critical element to any investment portfolio, which is the fees. Now, both of these funds are absolutely great because they're both passively managed. So by definition of something that's passive, it actually doesn't require a hell of a lot of work for the Vanguard portfolio managers to actually maintain both of these portfolios. As a result, their ongoing charge fee is extremely cheap at just 0.07%. Now, the reason why I call out fees specifically is because it's such a critical element to any investment portfolio's long-term performance, because if you pay too much in fees, it can drastically affect the long-term value of your investment portfolio. In actual fact, the SEC wrote a report which actually showed the impact of differing fees within an investment portfolio. So as you guys can see, this report has been written with a $100,000 initial investment and compares the difference in fees between 0.25% and 1% with a 4% annual rate of return. And over a 20-year period, you would actually have over $30,000 less just by paying 1% in fees as opposed to just 0.25% in fees per year. A small percentage fee, which may seem quite negligible at the time of investment, can actually go on to actually cost you somewhere in the realms of about 15% of the total value of your investment portfolio in this specific example. And nobody wants that, so finding funds with low fees like the VUSA and the VUAG is certainly a bit of an advantage to you. And in actual fact, if you compare the fees within these funds amongst all of the other funds on the Vanguard website, then they're probably best in class. So of course there's lots of similarities between these two funds, but what actually is the fundamental difference between them? Well, the main difference between these two funds is how they treat their dividends. The Vanguard VUSA is a distributing fund, which simply means that they distribute their dividends to their shareholders, whereas the Vanguard VUAG is an accumulating fund, which means the dividends are accumulated and reinvested back into the shareholders' portfolio. So you have the VUSA, which pays you an income, whereas the VUAG contributes more towards your capital growth. But how exactly do these portfolios stack up against one another? Well, fundamentally, performance is the same from an equity holding point of view because they both track the same S&P 500 index. But with one portfolio reinvesting dividends whilst the other doesn't, how does that affect the overall portfolio value over the long term? Well, I think you guys will be pretty surprised at the difference because it's actually quite substantial. The total return on investment over the past 5 years for the Vanguard VUSA S&P500 ETF has been 86.56%. which is the equivalent to a compounded annual growth rate of 13.28%. Now, the longer term average of the S&P 500 is more closer to about 9% per year. But for the purpose of this example, let's just assume the S&P 500 can keep up this rather impressive performance and achieve that compounded annual growth rate of about 13% per year in the future too. But with that, it's probably worthwhile me saying that past performance isn't necessarily indicative of future results, and because of that, the information that I'm just going to put into here should just be seen as for illustration purposes only. Now, both funds obviously pay the same dividend at 1.16% per year, but the VUAG is registered as a dividend yield as not applicable because the dividend is automatically reinvested, then it doesn't ever hit your bank account. So assuming that that dividend of 1.16% is added back into the investment portfolio every single year for the VUAG fund, that would take the compounded annual growth rate to 14.44% per year versus the VUSA at just 13.28%. So with that in mind, now let's run some numbers. So assuming we can start off with an initial principal of £500 and we achieve that 13.28% annual rate of interest over a 40-year period, making monthly additions to that portfolio of £500 per month, increasing with inflation, of course, with 2.5% per year. That gives us an end total portfolio value of £8,283,575, having invested into the Vanguard VUSA S&P 500 ETF. However, when we account for the automatic dividend reinvestment in the VUAG fund, adding that additional 1.16% to the annual interest rate to take it to 14.44%, you can see the total difference in portfolio value, leaving us with £11,321,583. That's over £3 million more just from having the dividends automatically reinvested for you. So of course, when we look at the overall performance, the VUAG performs better because the way in which dividend reinvesting works is each time a dividend is reinvested back into your portfolio, essentially you acquire slightly more units of the ETF, and therefore in the future you acquire slightly higher dividends. Then over time, because you have comparably more units within the ETF, the higher the amount of dividends that you'll receive, and the snowball effect kind of takes place from there. So which fund should you choose? The dividend distributing fund in the VUSA or the accumulation fund in the VUAG? Well, for me personally, I have the Vanguard VUSA S&P 500 ETF within my own investment portfolio because I'm not too concerned with the, functionality of having those dividends automatically reinvested for me because I can pretty much do it myself. So I still get the same benefit as the VUAG, I guess it's just a little bit more manual effort on my part. But the big difference for me is that I'd like to be in a position when I'm older to actually draw somewhat of an income from my investment portfolio. And if I do ever get to the value of an £11 million investment portfolio, then the dividends going into my account would be in excess of £131,000. So you do kind of get the best of both worlds from investing into the VUSA, providing you're disciplined, of course, with reinvesting back into your investment portfolio rather than taking out the cash and spending it. So weighing everything up, whilst I'm still very much far away from the total portfolio value of 11 million quid, at this moment in time, my Vanguard VUSA portfolio still pays me out a dividend of about £35 per quarter, which is pretty cool to see, adds up to around £140 per year. However, if you do want to have all of the functionality of the dividends accumulated and being reinvested back into the portfolio, then the VUAG might be the right fund for you. However, the only downside is that the VUAG isn't actually available on the Vanguard UK website, which is certainly a little bit of a pain in the arse, but it is available on apps like Trading 212 and Free Trade, which I'll leave some links to down in the description below. So with that said, guys, be sure to let me know what your preference is between the Vanguard VUSA and the Vanguard VUAG. But before you go, if you do want to see what some of the other top funds over on the Vanguard website are, then be sure to click on this video here. And with that being said, I'll see you over in the next one.